in this zone is where we are actually expecting to get triggered in and then move along with the big boys, right? So that is exactly what we're going to be demonstrating with. When it comes to supply and demand, this is a concept that applies to anything and just about everything in life, right? So where there is increased supply, that means that it's easier to get that product or to get that service, right? So you don't need to put much effort, and hence in the market as well is the same, or in business. If the supply is increased, that means you can get the access to the product or service at a much cheaper rate than when the demand is high, right? So that is the same that happens in the market. When there's increased supply, we can expect the market to actually start falling, right? To start selling. We can expect the investors to start selling their positions and basically looking to get in a more premium demand price, right? So that is what we are going to be explaining in this video for you, with illustrations as well as market live, actually breaking down on the market charts as well. So stay tuned to actually see how we apply this knowledge onto the charts as well. The opposite applies when it comes to demand, right? When there's increased demand, it's basically hard to get your hands on that product or service, or otherwise the price will actually be increased, right? It will be expensive. That's when the product becomes expensive, because it's limited supply and people just want to get their hands on that product. So allowing people to sell it at a premium price than provide it at a lower price, right? So this concept applies in everything in life, allowing us to apply it in the markets as well, because remember, in the markets it's actually real people moving these markets, right? So we may call them the big boys, but still behind that there are actually people that are making these decisions in the markets, right? So that that's how the markets move every single day, right? So if a company wants to invest in South Africa, let's say they want to buy the South African rand, they have to come spend their dollars with us, right, in exchange for that rand, right? So it depends now how many countries or how many companies wants to invest in South Africa. That increases the supply and demand for the rand, and basically that affects the price. The more supply that we have of the rand, meaning that we don't have much investors interested in investing in this country, that means that the rand will actually be accessible to them at a lower rate. But when there is like a booming industry in South Africa, a lot of investors want to invest in our country, that means now the demand is up, right? So that will keep pushing the rand value higher. So that's basically just to explain the concept of supply and demand to you in a nutshell, right? So as I said, in our course we go deep into this, but that's basically what you need to know and understand when it comes to supply and demand. In the forex market, we basically have three trends: moving in an uptrend, we're moving in a downtrend, or we are consolidating, right? So what happens is when there's consolidation, that means we have an equal demand and supply in the market. There's no increased demand, there's no increased supply for the product. So basically it's just this is when we experience consolidation, when there's no really any major movement in the markets. So how does this really work? Well, the big boys, when they come in the market, they come with a lot of money, right? They place their orders at certain areas in the markets, and basically when they place their orders in these areas, basically they cannot have all their orders filled in just one go, right? So the market has to come back and then fill in all the orders that are still there. And how you notice these areas basically is market moves either if it's a supply zone, you see it by market dropping very fast with huge candles from that zone. That's how you determine that this is your supply zone. If it's in a demand zone, basically the market will buy from that point with the huge candles, and then later on come back to fill in the rest of the orders that are left in that position, right? So depending on how the market moves from that position, it also shows you the amount of momentum or how much orders there are actually at that point, right? So the bigger the move, the more you can expect the market to actually come back and then again give you another move, right, on that market. So the best tip that we can give you is just to always be looking for new opportunities, new supply and demand areas, because once it's tested more than once, that means basically the orders are getting less and less, right? So the chances of it bouncing off from those supply or demand zones, but again they decrease each time it comes back and bounce off, because it's basically just finishing the orders that have been set over there. Now another tip that we can give you is to focus on the bigger time frames. So the H1, obviously a supply or demand zone on an H1 will have a stronger effect on the market than those on a lower time frame, the 1 minute time frame. It might be just some small orders that has been placed. So once the market comes back to retest it on that 1 minute, it might get liquidated and then it's out, right? All the orders are filled in and the market has no interest in coming back into that 1 minute supply or demand zone. So the bigger the time frame, the stronger the zones will be. And again, I will repeat, always look for those zones that the market has not tapped into as yet. Those have the more potential of the market actually coming back to test them again. Now Now let me just go to some visuals that we can present to you. Just using TradingView right here. We are on a Nasdaq 5-minute chart over here, but we're not looking at the chart as of now. I just wanted to show you how these demand zones actually form, right? So how do they form? And basically this is how this demand zone forms. As you can see over here, we have a nice illustration of demand zone and how it forms. So I'm just going to grab my paint brush here, and basically what we can see right here, we have a move. We are talking about the demand zone right now, right? So we have a move up, and then we have it right over here, right? So this is the area where the big boys have placed their order. We're now expecting the market to come back and basically retest the same area. It might not come exactly to the same point, but it's a zone, right? We call them supply and demand zones, not basically to a T, like like support and resistance where you have an exact number. This is a zone, so the market can come back in the zone, and then we basically we're going to be showing you how to draw those zones so that you don't miss out on the entries. So just stick around for that. But basically we are looking into the zones, right? So basically the market takes off with their orders over here, but then not all orders will be filled over here. And we remember what we said about this. We see these zones by the huge candles that move away from this zone. So they pretty much do it very quickly, right? So they usually like 2-3 bullish candles from that zone. That shows you that this is a serious demand zone, right, that you need to look at, right? So once you upload this demand zone, you'll basically be looking for an entry over here, right? So maybe this is an hour's chart. When the market comes back into this zone, we now go into our entry time frames, which will be the minutes and the 5 minutes, so that you can see how the market structure is playing out in that zone. So when you get, maybe it's a W formation, it's a head and shoulders on a 1 minute, that is how you'll be able to capture those sniper entries at these zones, right? Just based on a higher time frame supply or demand zone. Now looking at the supply zone is basically just the opposite of demand zone, right? So the of course, when it comes to the supply zone, we are looking into selling, right? We're looking to sell when the market creates those lower highs, right? So this basically we have a lower low over here. Remember, the market, when it moves in, when it is going in a downtrend, it creates a lower low as well as a lower high, and then comes back to break the previous lower low, creating another lower low, and then comes back to create a lower high, right? So when it comes back to create this lower high here, that is where we are looking for entries into the zone, the supply zone that has been created over here. Once again, we see this supply zone by the huge candles that move away from those zones that we are seeing, right? From where the market has created that lower high, that is where we are looking to get our entries and join the big boys, right? So when we let the big boys or the market makers make their moves first, then we follow in the direction that they are making, right? We don't lead the market, we always follow what the big boys are doing. That is the best way to trade. So a supply zone, we find it in between two lower lows, right? So this will be our lower low, and then another new lower low, and this is our lower high over here, and that is basically where we find our supply zone, right? So that is where we are expecting the market to actually come back to tap in that zone. So remember, we said it's a zone, right? So it doesn't have necessarily come back to the tip over here, but basically is this whole zone that we're looking at, which basically we are looking to get our entries from zones and not exact points on the markets, right? So you have to keep that in mind because it's very, very important. Now I'm just going to take a look. Now we're just going to move on to a chart here, which I just plotted some of these zones so that you can see how effective they are and how basically we plot them, right? So right now we are on the H1 for US30, which is basically the same, almost the same as Nasdaq, NAS 100 over here. So some of these moves, you see that they actually there are days where these markets move in the same direction because they're basically almost the same, right? So what we're going to do is just take a look at these supply demand zones that I've plotted over here so you can take a look at how to draw them and how to plot them, right? So basically they just start from here going backwards, right? Yeah, let's start from here going backwards. So when it comes to drawing the supply and demand zones, there are two ways to do it, right? So the first one is basically we are looking at the weeks, right? So as you can see this week over here, in most cases in this bullish market that we're seeing right now, a wick to the bottom will either be a bullish engulfing candle, or maybe it's a head and shoulder or a W formation, right? Just depends on what the time frame you are looking, lower to that time frame on the higher time frame, right? So it's just like it's a sign to show us that the market failed to break or to close at that lower price. That is the first thing that we need, that we look at. So basically the wicks is what we'll be looking at. And then the second one, so let's say we are in a demand zone, we are looking for a demand zone, right? So remember, we said when it comes to the demand zone, we'll find it in between the two higher highs, right? So when the market moves high and then comes back and then makes another high over there, we are looking into this point over here, which will be our demand zone, right? So that is where we are looking at over there. We're looking for the market to actually come back and then give us an entry in that zone over there. So that is where we will be looking for a demand zone over there in this area like that. When you are looking for a demand zone, for you to plot this block over here where you're expecting the market to look at, we are looking at the last bearish candle, higher high to make a new higher high. That is where you are looking to plot your block, right? So right now we are going to take a look at an example of a demand zone. So as you can see, we just drawn our block over here at the bottom, right? So as you can see, we have a couple touches on this block right here. And remember at the start, we also talk about the aspects of trading that you need to have, and patience is one of them, as well as discipline, right? Which is something that we said we cover in the course, right? But right now, this is an example of where patience actually really pays off, right? So as you can see, so we had a couple entries in these trades over here, and we were only able to capture it on the third move over here. That's, as you can see, that is when it actually like took off and then made the biggest move. That's when it actually started, right? But basically the first two entries, we made our entries and then we're trailing our stops. We're trailing our stop loss. If you're part of our students or you're part of our signal groups, you already know that we don't really trade using take profits. We like to trail our stops so that we can capture the whole move, right, all the way, right? So as you can see here, we are only able to capture on the third move. So why did we actually come back and we re-enter this every time that the market came back to retest our zone? Why did we enter another trade? Basically the reason for that was that on the 15-minute we actually have a nice W formation, which was on the 15-minute chart, right? So that is why we entered more trades, right? So it's just about patience, discipline, and then following your rules, right? So the W at the lows of the day, I think you know that part of the day and night strategy, right? So that is just a quick explanation of what was happening here, right? So basically support and demand zones are more powerful when you couple them together with W formations on a supply zone as well as M formations on a demand zone, right? So it's just like extra confirmations, which basically like gives you a higher chances or higher possibility of your setup actually working out, right? So to just expand on that, we have a couple examples that we have here from the trades that we actually took. So as you can see, these are some of the screenshots from January, as well as the other one over here that we're going to cover, which is just a recent week from February, right? So that was basically last week, right? So we're just going to take a look at these and then show you exactly how the markets basically work, right? So as you can see, some of these zones that we had here that we took. If I grab my paintbrush over here, as you can see, with this moves over here, we had our W formation, right, as well as our zone on H1. So there was a zone on H1 which is around this place over here, right? So basically that is where we took our trade from this zone that was on the H1. We took our trade. We had a W formation on the same setup as well. As you can see, we pushed up all the way, and then we were just taking more trades, right, as the market goes. And then when it came back, we just take more trades because we are seeing the W formation, right? It's just an extra confirmations, and we're already moving away from a supply zone that we had here on the H1, right? So in this case, as you can see, it actually played out and we were able to capture the whole move, right? So right here, as you can see, this is on M1 time frame. And then if you can take a look, an example of demand zone here on Nasdaq, as you can see right here, we basically had our demand zone on H1 again, and then now we dropped to M15 to just see more of this setup in a clearer way. As you can see, we also have an M formation right here, double top, if you want to call it, as most people call it. But basically, as you can see, what happened in this is basically still it's just the opposite of the supply zone with the W, but now we're looking to sell from the demand zone going down, right? So as you can see, we had our first touch over here, and then our second touch over here, right? So when we entered this is actually a bit more risky, but we also had some negative fundamentals on this day. As you can see, that's why we later on had this huge candle that just sold off later on. But basically, we just held the trades, and then when it came down, you know, created a small W formation there, and then we came back to create the second leg over there. And then that's when we knew that, as you can see with these spikes, the spikes basically just showed us the loss of momentum, right? There was no more momentum, meaning that the buyers were now exhausting, right? So as you can see, the spikes that are there, let me zoom in for you a little bit. As you can see, the spikes that are there creating the second leg of the information, right? So that just gave us extra confirmation that the market was about to tank, right? As you can see, together with the negative fundamentals that we mentioned earlier on. And then boom, the market came and just fell just like that, right? As you can see over there, and we ate and that was another successful day, looking using the demand zones together with the double top or the M formation. So it's just more powerful when you put it together like that. So if you can just take a look at it, the last example that we have here, we actually traded the same on VIX 75, as you can see right here. This is on M1. We basically had a setup on M1. We had a zone over here, right? And as you can see, we have our W formation over here. So in the course, we also covered the different types of W formations, right? So you won't always have like the best, the perfect W formation, right? So maybe it won't be exactly always like leveled at the bottom, right? So sometimes you get it with a lower leg, or you get it with a higher leg, right? So in this case, we actually had one that looks something like that, right? So with a leg that is higher than the first one, but still we are looking at our W formations, right? And we had our supply zone as well, and that basically just, you know, together gives us more confirmations, and then we are able to capture these trades as well, as you can see. So that just allowed us to actually capture these trades as well, as you can see right here, and basically we killed it, right, on the M1, but the zone was on the M15 or H1 for this setup over here. So as I said, we go down to this lower time frames to actually find those perfect entries, right, so that you can get in at the best prices when you get that extra confirmation, right? Like for example, in this case, the W formations which we are saying, the W and the M formations that go very well together with this zone. So be always on the lookout for these W formations and M formations when you're trading with the supply and demand zones. If I can just take a look at another example over here. Right now we just looked at a demand zone. Now let's look at a supply zone example. So all right, so in terms of the supply zone, basically what we're looking at, as you can see, I'm just going to go through this example over here, right? So what we are looking at is basically when the market comes back into this zone over here. So basically remember, we have a lower low, right, and then we have a new lower low, right? So in between those two, this lower high over here is where our supply zone is going to be created, right? So we'll be looking at, remember now we are looking for a supply zone, so we're looking at the last bullish candle. That is what will give us our supply zone, right? So with this example over here, so now it's not always that you need to refine your entries. We could have used this candle over here. It's also a nice one, but as you can see, the candles that moved away from there, they were not very decisive in the direction compared to these ones that you're seeing over here, right? So this entry over here could have also worked. I mean, if you can just take a look at it to see how much we could have been able to make. I mean, if you make the entry at this lowest point of this candle, remember now we are selling, so we're looking at the lowest point and not at the highest point, right? We look at the highest point for entries when we are buying, at the lowest point of the candle when we are selling, and then at the highest point of the candle when you're buying, right? So you just need to keep that in mind as well. So right now, as you can see over here, and remember we said we always give some room for the market to breathe over here. So if you put it right on top, you'll basically be kicked out, right? But if you give it some room to breathe, maybe 5-10 pips above that candle, above the highest point, as you can see over here, and then we'll be targeting the previous lows where the market had started, right? So our entry will be somewhere here, and then we'll be targeting these lows for our first TP, right? But remember, when the market is in that trend, we are expecting the market to break through those recent lower lows or those recent high highs, right? So in this case, the market actually did break through that, and then came a bit lower than that. But here that was in 1:3, you know, 1:1.3, which is not very good. Remember, we're aiming at least for a 1:2, 1:3 as our risk to reward ratio, right? So in this case, this would have been the best. This would have been a best TP over here to get out of there. But anyways, we did not take that trade over there because we're not too convinced with these candles over here. The momentum was not enough to convince us to actually take the trade, right? So we went on and waited for this one over here, and basically, as you can see, we had this candle. We just refined for 15 minutes, but it's not really necessary looking at this sides of this candle, right? So basically, if we can just take a look at this candle and then reset our entry back to this position, even if we just reset it without any refining, right? So that entry that you saw there is actually after refining this candle on the 15-minute chart, right? But right now, just staying with this candle, the H1, basically, as you can see, we could have been able to get a trigger right over there, and our first TP will be the previous lower low right over here. So if you can just pull back our TP to this point right here, we'll be looking at a nice 1:3.66, or almost 1:4 over here, 1:3, which is not too bad, right? But as you can see, the market, if if you were able to actually hold this trade for longer than that, you could have been able to capture 1:5, 1:6. But the most that it went all the way down to the bottom over there, in this case, you would know maybe we are having our upper trend line, at this point over here. And basically what will happen is we're expecting the market to do the same on the downside, right? So on the downside, we would expect the market to give us a similar move. And basically that would, give you that position right there at the bottom, right? Okay, so now that we have shared with you all the information that you actually need in order to make some money trading the supply and demand zones, as well as putting it together with the M and W formations, as we said, they work actually way better together. Right now, we're just going to share with you a few more tips that you need in order to actually make it in this industry, right? So a lot of traders run after every new strategy that they hear about, but never focus on letting go of emotions and fear. And these two actually play a huge role in Forex trading. It will play a huge role in your Forex journey, because Forex will deal with you to an extent of you being afraid to even execute the smallest lot size in the market. You'll be so scared to enter any trades because you don't want to lose money again. And we don't blame traders running to the next strategy, because market conditions are forever changing, right? It's a forever changing industry, and even the best traders will have to evolve with the market if they still want to make profits, right? So most traders actually don't adapt to the new market conditions, and that is why they end up taking profits way too soon. And also on the negative side, they actually cut losses late because they're not adapting to the market. They're using their outdated strategies that don't apply to the current market anymore, right? So you have to adapt to the market as well, right? Now, one thing that I've noticed among a lot of traders, that some of you don't even know yourselves. You have to find yourself first, because you can have all the knowledge that the next trader have that who is making money, but then you yourself still don't make profits like how they are doing it. And this can be caused by a small difference in personality. And this is the reason why you need to know yourself first. And in Forex, one problem leads to another. So for example, you might be a person that gets excited over wins and you get angry over your losses, meaning you're a sore loser and you don't take losses very well, while the next trader treats wins and losses the same. No reaction at all, just another bad day at the office, and basically just close the charts and go for a run or something like that, right? You, in comparison to them, you stay stuck behind your screen and revenge trading, trying to recover your losses, right? So this is the difference between winners and losers, right? So such small difference in personality basically can just ruin yourself when it comes to becoming a successful Forex trader. After that comes increasing the lot size and trading setups that are not even part of your strategy, just to revenge trading, right? Out of emotional reaction to the market. Can you see where I'm going with this when I say one problem leads to the next one? Because this whole sequence here just started with someone reacting with anger to their losses, and basically you end up revenge trading, possibly blowing your whole account. And as soon as you know it becomes a pattern where you break all your rules, all your trading rules. Therefore, it is very key to figure out first if you have a problem with the method that you're using, your strategy, or if you're having a psychological problem before you actually take action on this. But first of all, you must identify your problem and become aware of the cycle that you are looped in, and then make changes to break out of it. You have to realize your problem first, identify it, and then try to break out of it. Maybe, for example, your problem is overtrading. Then you have to recognize why you are overtrading. Maybe it's because of boredom, or maybe there is something you want to buy and you need money fast, or you have nothing to do during that time but to sit at home all day and press buy and sell on the market, right? So you have to recognize your problem, analyze what is going around it, what is causing you to do these things, and then try to tackle it from there. So after recognizing the problem that you have, then the next thing is basically you have to find a way to control your problem. For example, if you trade because you are bored, basically you just need to find a hobby or something to replace those few hours that you're spending in front of your charts looking at dead movements like you're watching a horror movie.
Damn, son, where'd you find this?
Anyways, if you are a swing trader, there's no need for you to be in front of your charts whole day. And even if you're a scalper like us, because we're also scalping, there's no need for you to stay stuck watching the market the whole day. Yes, we may miss some setups, but the ones that we catch make up for all the others that we may have missed. The way we do it here day and night, we basically just only look at the charts when it's New York session, and basically that's at 3:30 or 4:30 South African time, and that's basically the move that we are aiming to catch. After that, we are done with the market for the day. There are times when we would some trade setups in the London session if the move is actually clear, but we prefer volatile markets, which we find in the New York session. We take our profits or losses, then we continue the next day. That's it for the day. That is why we have more wins than losses, because we stay disciplined, right? We don't react to our losses, and neither do we over celebrate our wins as well. The market is forever changing in its volatility as well as the trend, so you need to get rid of this mentality of saying Nasdaq is always a buy. The strategies that are dominating the market now are not the same strategies that dominated the market 10 years ago, right? Successful traders are always studying the market and adapting to the new changes. The easiest way to spot market changes is in your strategy. If the same method that you use gave you more wins than losses in the past, and now the same rules that you're following are giving you a loss after loss, then you know that it's time for you to adapt to the market changes, and you need to look back into your strategy and see what you can change to adapt to the new market conditions. That is why trading robots that gave you good returns in the past are now blowing accounts, because the strategy the developers coded back then, which worked back then, they are now outdated and don't adapt to the new market conditions. So now what most of these mentors do, they simply just rename the robot and sell it again, selling the same old robots that have not been upgraded to trade the new current market conditions. That's why a lot of their clients are blowing accounts, because of the big drawdowns from these EAs, which they didn't even code themselves. The only reason why they are making money is because they fund with big amounts, and they don't even warn clients that the robot doesn't accommodate small accounts because of the deep drawdowns, which will blow their small accounts before making the profits. So now they only show their results to the public and block those complaining clients. So this industry is actually quite deep. All of us traders have different strengths. That is why no trader will ever be like the next trader. Each and every single trader is strong in some areas. It might be focus, it might be discipline, maybe tracking fast moves, spotting those entries without even analyzing the markets, or whatever the case may be. But each of us as traders, we are good at something that maybe the other trader might not be good at. For example, myself, I'm a day trader, basically a scalper, and I track moves very fast. My mind works fast and my eyes now are able to see patterns that have not even formed yet whilst they're still in the process. I also process real-time information very quickly, and I execute scalp signals on the M15 instantly. So when it comes to quick decisions, bank trader is your guy. And then you get those traders that behave like investors. They take decisions slowly and analyze every time frame before making that decision. They are more focused on long moves that they catch on those bigger time frames. They think deep and go into depth in different areas, spotting information that other traders didn't see. So that's their strength compared to other traders. Again, we all have different strength when it comes to this forex industry, and it is key for you to figure out what is your strength. So once you have figured out yourself, the next thing is actually to be a bit more creative, because if we all trade the same way as everyone else is trading, we'll all get the same results. You won't be able to stand out of the crowd, right? So creativity is actually key. So simply adjust that strategy until it works better for you than any other people. Be more creative with the strategy, right? Make it work for you specifically. If you have any questions, you can always leave comments down below and we'll get back to you, right? So let's get straight into it. Welcome back to Day and Night Forex YouTube channel, and on this channel we share different ways of making money online, mostly on forex trading. And in today's video we are going to be talking about the smart money approach to the forex industry. It allows you to enter the market with a smaller stop loss than the average approach that we usually have in most strategies, right? So as we said, this is something that is quite new to the industry, but it's also getting very, very popular amongst most traders. So we decided to put out this video so that you can have a complete guide on what exactly it is and how you can also have an approach to it. So in this video we are going to be breaking down these concepts over here, starting off with market structure. Basically with market structure, it's nothing new. It's basically market structure will always be the same thing, right? So it's basically the highs and lows, which is basically the sequence in which the market moves, right? So you already know, if we were in an uptrend, we have our higher highs, higher lows, higher highs, higher lows, higher highs, and basically this is our uptrend, right? So inversely, when we are in a downtrend, we are making our lower lows and then our lower highs, right? So lower lows, lower highs, lower lows, lower highs, lower lows, and that's basically the market structure, right? So this is the market structure to the downtrend. This is market structure in an uptrend, right? So that is basically the basics of market structure. As we continue with this video, we're actually going to talk about something which a lot of people find quite confusing, right? So which is the difference between between what is called the choke and what is a break of structure, right? So BOS. These are the new smart money concepts, which basically refer to something that you might be familiar with. And basically the choke right over here, which stands for change of character, is simply when the market decides to actually turn from an uptrend to a downtrend, or from the downtrend to an uptrend, right? So we actually have some visual examples right here at the bottom, so that we can give you a clear perspective on what we mean by that, right? So as you can see over here, we just have an illustration to show exactly what is a change of character, and then what is a BOS, which is a break of structure, right? So as you can see over here, this is an example of a downtrend turning into an uptrend, right? So as you can see, right now we are in a downtrend. We're starting off with the break of structure. Break is the impulsive move in this direction of the trend, right? So remember, when the market is moved, we have the impulse move, which is the major move in the direction, and then we have what we call the correction, right? So the correction is the pullback, which is basically allowing the market to basically breathe before continuing again and giving us an impulsive move in the direction of the market, right? So that is what we call the break of structure, right? So that movement, that impulsive move that goes past the previous level to create a new level. So in this in the downtrend, basically the impulsive move that goes to break previous lower low to make a new lower low, that is what we call the break of structure, right? So this what is happening here is what we refer to as the break of structure. So that break of that previous lower low to create a new lower low over here, that is the break of structure, right? So now this one, as soon as we start to have that correction or the pullback, that means now we are anticipating that there's going to be a new impulsive move in the direction of that trend, right? Of the downtrend to continue with the trend. The moment that the impulsive move comes to retest this low over here and succeeds in breaking it, that means now this one is no longer the lowest low. We now have a new lower low, right? And that is what we refer to as the break of structure, and that is what we mean by break of structure. Now, inversely to that, we have what we call the change of character. Now, change of character is basically when the downtrend is changing into an uptrend, as you can see over here, right? So this is the turning point in the markets, basically, for the market, right? So as you can see, when the price is changing direction, right? So as you can see right here, we have another break of structure over here, and then we have this impulsive move over here, and then we came back to create that pullback. But then this pullback, as you can see, it actually went higher than the previous lower high over here, creating a point that is higher than the previous lower high over here, right? So as you know, as soon as we have something like this, when a lower high is broken by a higher point than it, that means we are now anticipating a change of direction, right? Every time that we have a point that is higher than the previous high, that means we are starting to have our uptrend, right? So remember, the uptrend is higher lows and higher highs. A starting point for our higher highs to so that we can actually anticipate to have another higher point than this one over here, and we're no longer anticipating the market to go down all the way below this lower low point over here, right? So that is our change of character. So that it is basically that break of structure is what we're calling the change of character, right? So as you can see over here, it came to break this lower high over here to give us a high, and then we came back here and got now we can call this a lower high after the market has basically broken structure over here, right? So this is our new BOS over here, right? So this is a new break of structure because the market came back, the correction move that it gave us over here before it gave us an impulsive move in the new direction over here, which went higher than this high over here, confirming that we're starting an uptrend, right? So therefore we refer to this as a break of structure, as now this is the new direction of the market, right? So the same applies to the downtrend movement. So as you can see right here, we are having our break of structures as the market is correcting and then impulsing back in the uptrend movement, which is the current trend in the current market that we are at in this point, right? So that is the current trend that we're in. We're in an uptrend, so we're making the impulsive moves to the up and then the correction over here, and then that gives us the break of structure as soon as we have an impulsive move that moves higher than the previous higher high over here. So remember, these are our higher highs, these are our higher high points over here, right? So and then we have our higher lows, so the higher lows over here, which are made by our correction points, right? So when the market corrects before it gives us another impulsive move, which gives us the break of structure as we are moving in the right direction of the trend, right? So but as soon as we fail to have another higher low over here when the market is correcting, and it comes back to break this higher low over here, giving us a lower low, right? So again, this is the change of direction. This is the break of structure. So this is what we call the change of character, right? So the break of structure, when the market is turning around and changing from one trend to the other, this is what we call the change of character, right? So that is just what you need to understand about this. And that when this happens, it actually gives us the opportunity to find trading opportunities, right? So because the market, before it actually starts going impulsively in the new direction, if the market will always come back to retest some levels, right? So back to fill in some orders where the big boys have turned the market around from, right? So where maybe the unfulfilled orders, buy orders or sell orders, that will be at these levels where the market has turned around at. And so that actually is where we'll be anticipating to hop on the market and basically go with the big boys, right? So right along with the big boys, right? So basically this is what we wanted to break down for you to actually illustrate and clearly differentiate between the change of character and the BOS, right? So which is the break of structure, because we've seen most people have been struggling with that. So that is basically it, right? So now to move on with the rest of our video, we have what we call the point of interest, right? So again, if you can just come back to this these illustrations that we have over here, basically the point of interest is where we're anticipating to enter into the market, right? So this is the point of interest over here, right? So where we find our order blocks. And if you are new to the concept of order blocks, we have 2 videos that we recently uploaded on this channel, so you can just go watch those videos to understand what exactly are order blocks. But basically order blocks, they come in different variation, right? So some of the most common ones is basically the bullish or bearish engulfing candles. That is where you will be finding your bullish your order blocks, right? So at these levels, those are what we refer to the point of interest, because we are anticipating that the market is going to go back to reach those levels, and that will give us an opportunity to hop on into the market, right? So and then when this happens, we actually have what we call imbalances, right? So this is what we define as refilling of gaps that are left in the market, right? So let's say, for example, the markets, as you can see over here, these huge candles over here, they basically show us that the market, there's so much momentum in the market that basically the investors, they're just pushing the market so hard, right? So at the moment, right? So right here there'll be so much supply, so basically the market is going down heavy at the moment, right? So these gaps over here, what we refer to as imbalances, are basically these gaps that are being left between the 1 week of the candle from the previous week of the other candle, right? So as you can see, this gap over here is what we refer to as imbalance, and we anticipate that the market will come back to refill those imbalances over here. And as we can see, if we just go into if we can just expand a little bit to the left, you see that the market actually came back into that zone over there, right? So if I can just quickly zoom out for you so that we can actually see, then as you can see, the market indeed came back into this zone. And basically when it came back into this zone, we'll be anticipating that the market will actually sell. So let's just see what actually happened in the future when the market came back into this zone over here. And then we open to the side. As you can see, this is where the market actually tanked down from, and basically because this is the way orders that were not filled when the market had so much momentum when it was moving to the downside, right? So the market came back to fill in those orders that were left before it continued with the downtrend, right? So those are the areas where we could be looking for trading opportunities, right? So as you can see, there are more over here, and basically you just have to plot all of them, because at some point the market is going to come back and mitigate those orders over there, right? What we call mitigation. The next concept that we're going to look into is liquidity, right? So this is the smart money traps, right? We have the 2 most common liquidity grabs that we have are the trend line liquidity, and then what we call the double top or double bottom liquidity grabs, right? So these are the areas where the smart money traders will know that this is where the retail traders are putting their money, right? So for example, here we have a double bottom over here, and the market actually came back just below that and then pushed to all the way to the upside again. The big boys will be anticipating that there is money that is being kept at these lows over here. So usually the retail traders would enter on this double bottom right over here, and then when they enter the trade, the stop loss will be just below that level. So the big boys will basically come and sweep away all that liquidity, all that money, and basically continue in the direction which the retail traders were seeing, but because they entered a bit early, they will be kicked out over there, right? So that is basically what we mean by liquidity grab, and it also comes back in the form of trend line liquidities, right? So what we mean by this is that as a retail trader, you'll be anticipating that the market will short every time it comes to these levels, right? So the big boys will basically push the market just above that trend line before they continue with the trend, right? So this is fake outs or traps, right? So in the market, so that the big boys can actually get the money that you are putting at those levels, right? So that is just what we mean by liquidity. At these levels where the smart money will know that retail traders have set their stop losses, they have set their orders, and they're just looking to take you out of the market before they push the market in the direction that you are anticipating, right? So it's all about patience and waiting for a proper setup in the market, right? So that you don't get trapped in this liquidity grabs, right? So and then we have the inducements, right? When it comes to inducements, it's basically just fake outs, right? So exactly what we know as retail traders, what we refer to as the fake outs is basically what inducements refers to in the smart money concept, right? Is that just when maybe you have a fake breakout in the market, or you have a fake retest of a zone before the market actually goes through that zone. So these are basically some of this most common smart money concept that you need to understand in order to apply this approach of or style of trading. And basically it goes deeper than what we just did. This is just giving you a brief explanation of this smart money concept, right? So if there are any of these that you actually want us to go deeper in, you can just leave a comment down below, and then we will try our best to explain them in more detail, right? So what we're gonna do right now, I'm just gonna remove all these drawings over here so that we can just take a look at some of these recent examples that happened over here on Nasdaq, right? So we're just on Nasdaq right now. We're on the H1. So remember what we said, you can set your levels on H1, and then you can refine them on the smaller time frames over here, right? So for example, here we had a turning point for Nasdaq over here just recently, as you can see this. So we are on the H1 time frame. So what we're just gonna mark a few things, but before we do that, in the recent video we shared a way to actually anticipate some of these turnaround points over here when it comes to smart money concepts, and it's basically using the RSI indicator, right? So I'm just gonna quickly put it over here so that you can see what we mean by that. So as you can see over here, this market was creating higher lows and higher highs, higher lows, higher highs, higher lows, and higher highs over here, right, before it broke down, which is basically our change of character that we're talking about, or the break of structure, right? So the change of character before it came over here. But as you can see, if we look at the RSI here, yes, it was making higher highs and higher lows, but as you can see, this point over here, we are now making lower lows and lower highs, right? So now the market has already turned around over here, but as you can see on the chart, we are still making higher highs and higher lows over here, right? So basically this is something that will give you a clue that, okay, the market is going to be turning around very soon, right? So we now be anticipating to be seeing a break of structure so that we can start looking for those trading opportunities. And this is just a quick trick that you can use. So this the RSI indicator set to the 14, which is the default period that comes with, right? So I'm just going to remove that so that we can just analyze real quick what happened with this trade over here, right? So if we can just quickly zoom in so that we can have a clearer view. So as you can see over here, higher low and higher highs, higher lows over here, higher high, higher high, and then another higher low over here, and then here we have our break of structure, right? So this is where we have our break of structure. So as soon as we have this break of structure, we're now looking for a point where the market will come back, right? So remember what we said about our order blocks. So our order blocks is basically the last candle, which is before when the market gives us an impulsive move that went to break down that level, right? So if we look at this level, that candle is clearly this small candle over here before the impulsive move that came to break this lower low over here to give us a new low point over here, a lower point over here, right? So we're just gonna quickly highlight this over here, and then we're gonna go down to a smaller time frame so that we can see if we can refine this and basically have a smaller stop loss, right? So remember, the goal is to have smaller stop loss, tight stop losses when it comes to the smart money concept, right? So now we are on the H1, so we're just gonna quickly go to the 15. Okay, so as you can see, we just came down to the 15-minute chart, and as you can see, this is the point where we got our order block on the H1. So now we're just going to refine this real quickly. We're just going to refine it. As you can see, if we can just move to the left a little bit, the point where we broke our structure is basically at this level over here, right? So we remember we marked it with the red line. So this is the point where we broke our structure, and the candle that broke that structure is this huge candle over here, this huge bearish candle over here. But as you can see, the last now as we go down to the 15-minute chart, the last candle, the last bullish candle, or the last candle before that impulsive move is now this small, almost a doji like candle over here, and that is the one that we're going to be taking as our order block, right? So I'm just going to highlight that one. We're just going to refine our whole zone into that block over there, right? So as you can see right there, and then we take the lowest point of that candle over there like that, and then we're just gonna go back and then see where would our entry point be. And as you can see, it's quite over there, almost straight to the T, right? So there was no time wasting whatsoever over there, and that is would have been our entry point. And in most cases, when it comes to stop losses, it's just above the order block over there. But we always advise people to put their stop losses above the most recent high over there, right? So which will be this point over here, so that you can give the market some room to breathe. But as you can see, even if you had put it just above this order block, you could have been very, very safe in this case. So if you can just pull out our short position marker over here and then just put it over there, our position marker over there, and then we just drag it to the left over here. I'm just going to zoom out a little bit. As you can see, this could have been a perfect trade over there with an entry. And basically, when it comes to your take profit points, you still be looking at the zones that are on the time frame that you got your order block from, right? So in this case, we are using the H1, right? So we're just going to look for the next point where we can have our take profit point at, and that would be the next zone where we are anticipating the market to basically turn around or push from, right? So as you can see that here we have a major support and resistance level at this level over here, right? So this is where we'll be anticipating that the market will actually turn around from, so somewhere around at this level over here, right? So that is where our take profit would be for this trade. So if you can just take it down to that level, and then let's just see how much was that we could have made from this trade over here. So which is a nice 1s to 13, almost 1s to 14 from this trade over here, right? So this is basically how you trade the smart money concept, right? So it's just about finding your zone or your entry point or your point of interest on a higher time frame, and then you refine it on a smaller time frame so that you can have a perfect entry and a smaller tight stop loss, right? So again, we just saw another entry opportunity that you could have had right at the turning point of this market as well, when it turned around at this point over here, right at this lowest point over here. So again, we are on the H1 right now, so I'm just going to quickly zoom in again so that we can see what we are doing much more clearly. So as you can see right here, the market was giving us, so we have a low over here, we have a lower high over here, we have a lower low, and then a lower high, and then we have a lower low over here, right? So the break of structure is basically when the market broke this lower high over here at this level over here. So this is where we broke our structure, right? So basically, if we look at this level, the last candle before the break of structure, which was broken by this candle over here, would be this one over here, right? So, but as you can see, remember what we talk about? We spoke about the inefficiencies, right? So in this case, you can see that there's a clear inefficiency at these levels over here, right? So I'm just gonna mark them. So remember, the inefficiency you can also refer to as the imbalances, right? So the market came to this zone over here, but then the next week it only came back to this level over there. So if I can just quickly mark it for you as well. So right over here, right? So this so basically it left some inefficiency, some imbalance in those two levels over there. So the market would basically come back to get into those levels. So this will make our ideal order block the next one over here, which is this one over here, right? So we're just gonna highlight that order block right there. Okay, something like that, right? So and then now we're gonna go to the 15-minute so that we can see if we are able to refine this order block over there, so that we can perfect our entries, right? So that we can increase our risk to reward ratio over there. So I'm just gonna quickly let's just find this level real quick, and then we're just gonna quickly zoom in again. So as you can see over here, right? So now again, this is our break of structure. So our break of structure happened at this level over here. So we are looking for the last candle before the impulsive move that happened over there, right? So as you can see right now, if we come back to the to this lower time frame, we don't have imbalances anymore because the wicks basically is a week to week, right? So basically we can look at the last candle before the market pushed to the upside, right? So that will be this candle over here. That is the only one where we are seeing some inefficiencies that the market would actually come back to retest to, right? So again, so we're just gonna refine this block. So I'm just gonna move this block to that level real quickly. So that will be this block over here. So we put it right at the tip of this, and then we put it right at the bottom of that wick over there, like that, right? So and then we go back to the future and then see whether our entry point would have been triggered, right? So as you can see, this will be our entry point over here, or maybe if maybe with spread you could have been triggered your trade over there, but basically this will be our entry point. So I'm just gonna quickly take our long position marker so that we can see where this how far this entry would have taken us. So I'm just gonna put it right over there. And then our stop loss, again, remember what we said about stop loss, it's just below the order block, but you can also, if you want to be safe, you can put it below the previous low over there, right? So for this case, for this example, we're just going to put it right below this level over there, right? And then I'm just going to quickly again zoom out. So remember, your entry point is basically based on the H1, so we can quickly go back to the H1 to set our take profit points, right? So I'm just going to zoom out. So our take profit points over here would have been either this one over here or this one at the top over there, because basically when the market is in a downtrend, we would anticipate that it will come back to retest this level where it broke so that it continues. Otherwise, if the market is going to turn around from this point, we're anticipating that it will come to create a higher point than this previous high over here. We are anticipating that the market would come back to retest either this previous lower high level over here, or to come back to retest this previous high point over there, right? So if we can just quickly drag our points right over here, that will give us 1:3, 1:3, 1:4. But if you come back all the way to this level over here, we would have seen about 1:9, 1:10. So we set our point over there, which is a previous higher point, right? So that is where we anticipate that the market is going to go. And as you can see, over time, it did eventually reach those levels, and our take profit was hit, right? So the market actually went higher than that. And basically, yeah, that is basically the smart money concept in a nutshell. If you want any deeper explanation on any of these concepts, you can just leave a comment down below, and we'll try our best to bring out those videos in the coming weeks, right? So with that being said, thank you very much for watching this video all the way to the end. If you got any questions, you can always leave a comment down below, and we'll get back to you as soon as possible. Don't forget to subscribe to the channel, like the video, share the video, follow us on our social media platforms for more updates. And if you're interested in joining our signals group, you want to trade with us, you want to trade as we trade, then you can simply check out the links down below or visit dayandnightforex.co.za, and you'll be able to get on our lifetime packages or monthly packages. It's up to you. Trade as we trade as well, right? So all our trades that we take, we share on that groups. So make sure to check that out if you're interested in trading with us. And with that being said, we'll be seeing you on the next one. Remember, anyone can teach you Forex, but here Day and Night we teach you how to win. So in this video, we are going to be looking at the most important things that you need to consider when you start off your trading, right? When you are trying to find those trading opportunities every single day in the markets, right? So basically these things come down to choosing the best sessions to trade. So in this video, we're going to be sharing with you what we think and know and have proven based on our trading and basically all the years that we've been in the market. We will tell you which is the best session for you to trade. So based on the times that we are here in South Africa, we're going to be sharing with you that. And then we're also going to be talking about Forex trading based on institutional levels. So in the previous video that we released a while ago, we spoke about trading Forex using the big boy strategy, right? So if you haven't watched that, make sure that you do go watch on that. But in this video, we're going to be talking about the trading institutional levels, what are they, and basically how to spot them on the market, right? Then we're going to jump into what are order blocks, right? So we're going to reiterate on order blocks as well, how to use them, how to spot them on the market and on the charts, and how to make use of them, right? So in this video, we're gonna go a little bit further and introduce two more types of trading order blocks, and basically these are called the trading mitigation blocks as well as the breaker blocks. So these are actually quite powerful, and we're gonna be explaining those exactly in detail. What are they? And last but not least, in this video, we also decided to bring you another simple strategy that has been that a lot of people have been using to make money in the markets, and that is called the TDI strategy, right? So this is using indicators for those who would like to have extra confirmations on their trading charts, or maybe you're just starting out and you're not very much good, or you're not very much familiar with trading with, you know, the clean charts, right? Trading market structure as we do here at Day and Night Forex. But basically we're going to be showing you how you can make use of this TDI indicator. Some of the advantages of this TDI is that it will actually show you some WNM formations much clearer and much easier, instead of you waiting for it on the patterns, right, on the charts itself. So it will actually show you those in a much simpler way, and basically shows you the continuation and reversals of the charts. It shows you the stop hands, you know, a lot of things. It actually makes it easier for you to find your entries and exit points, and even divergence, which is something that we're going to explain a little bit later in this video. So all this information to help you master your trading and trade basically the way that we do here as the big boys. So if you're interested in knowing everything about what we just said right now, make sure that you stay tuned all the way to the end, as we're going to be breaking it down step by step for you. So without wasting much of your time, let's get straight into it, right? So starting off with the best sessions to trade. As you might know, or most of you might know, we have the most 3 common sessions in the Forex markets, right? So we have the Sydney to Tokyo sessions, then we have the London session and the New York sessions, right? So there could be other ones like the Australian sessions and so forth, but we don't really pay attention to those ones. But these are the key ones that you need to understand, right? So the Sydney, the London, and the New York sessions, right? So when it comes to the best sessions to actually trade, before we get into that, we need to help you understand that the market basically moves in 3 phases, right? So in Forex trading, we have these 3 phases. The first one being accumulation, which is also referred to as consolidation, right? This is when the market has no trend and it's basically just trading in a basic range, right? So it's between 2 horizontal lines, so a support and a resistance zone where they are basically it's limited, right? It's not a big level. If we can just quickly show you on the charts right here, we actually have Nasdaq here. We're actually going to go deeper and explain this TDI over here. But basically what we're talking about here when we have a range is something like this, whereby you basically just you are trading in a small range, right? So there's no trend. The market is just basically in a range, right? So it's going up and down, and here this can open up an opportunity for you to actually scalp the market. So maybe when the market comes down to this range, you can take your buys and then your sells at this level over here, right? So this is just a typical example of a range, and basically when we have this breakouts, which will basically show us the trend, right? So that is what we refer to as to the consolidation or accumulation phase, right? So after that, we have what we call the stop hands and manipulation. Now basically during this session, this phase of the market, Forex market, this is when the big boys are trying to take your money. They try to take you out of your trades, and they're trying to manipulate your trades so that you can think that the market is actually going in the opposite direction to what you are anticipating, right? And then they will take you out before the market is even going in your direction, right? So this usually happens with Nasdaq, right? Especially at 3:30 when the New York session opens, and basically there's just a lot of movements, and usually Nasdaq would actually go in the opposite direction to the actual direction where the market is going, right? So maybe you had entered your buy trade, maybe you entered your buy trade after a signal that you have seen over there, and then the market will basically come and wick it before you going in the direction of your trade, right? So usually, I mean, if you're just looking at this, if you understand price action over here, you can see that we had a bullish signal over here, which is a morning star, or a bullish engulfing over here. So basically this will be a signal for somebody to enter a trade, right? So in this case, they would maybe enter their trade over there and then set their stop loss just below the candle, right? And in this case, as you can see, that could have been almost hit over here, maybe due to spread, depending on the broker that they were using, right? But eventually you can see that the direction was actually correct, but then they got taken out by these wicks over here. So this is something that we refer to as manipulation, and it usually happens in the London session, right? So we're still trying to get to the point where we explain which session is the best and why, right? So and after the accumulation, we have manipulation, and then the best session to trade will be the ones where you find the trend, right? So after accumulation with the manipulation, then we have the trending phase, right? So this is the phase that we want to hop on the markets. This is when we actually want to look for trading opportunities and go with the trend, right? So remember, the trend is your friend. So this is when we are looking for opportunities to actually go with the trend and trade whichever side the market is actually going. Okay, so if you can visually explain this for you right now, as you can see over here, we have this time in South Africa. So this is the South African time, which is basically GMT +2. So depending on where you are watching this video, you have to convert that time or search up on Google what time these sessions open in your country, right? But basically in South Africa, these are the times when these sessions will open, right? So as you can see in the morning, this phase right here, which is around from 1 a.m. until around 8 a.m. South African time, this is when we are looking at it. This is when we are expecting the market to be in the accumulation or the consolidation way. The market is just ranging, right? It's not giving us an actual direction. And here you can do some scalping, but anyways, it's early in the morning. This is the time that you could be sleeping and just waiting for the market to actually open, right? For these sessions over here to open, right? So now when it comes to 10 a.m., as you can see over here, we now have a London session opening over there. This is the time that we're now looking to actually start trading. But with our experience, we've noticed that during this session over here, this is when a lot of manipulation happens in the markets. They're trying to take you out of your trades before they actually go in the actual direction, right? So this is why we prefer to trade starting from 2 p.m. over here or 3 p.m. over here in the afternoon when the New York session opens. And basically this is the best time to trade. Why? Because this is when the London and the New York session are overlapping, right? So these are the best times to trade because this is when there's a lot of money in the markets, right? Remember, most of the biggest banks and the biggest companies that are being traded on the markets that we're trading, especially the Nasdaq, they are all based in the USA or maybe some in the UK, right, in London, right? So this is when they are actually actively trading on the markets, and this is when the big banks, the investors, they are moving their cash during these times, right? So this is the best time for you to actually trade because there will be a lot of liquidity in the markets, and when there's a lot of liquidity in the market, there are more opportunities or potentials for you to actually pick up some good trades, right? So this is why we say trading during these times is actually the best thing that you can do, which is to trade between the overlap between the London and the New York session, right? So during the New York session, we're anticipating that the market will be giving us those trends, and the market will actually be going in the actual direction that later in this video we are going to be explaining about the order blocks. And basically what this helps us to understand is that once these big banks and these big companies actually in the market, the thing is, let's say they have an order block over here. So an order block, which we're going to explain later, but it's basically the way the smart money put their market, right, where they place their entries, and basically they have to push away the market from that entry so that, you know, they start making their profits, right? So in that case, when they put their orders over here and then push the market away from that level so that they can make their profits, this will basically help you understand why we say that London and New York is the best sessions, because this is when the big boys, they are in the market as well. So when they enter, they want to push the price away from their entries so that they can be safe in the markets, right? So this is exactly what these two sessions over here are the best for you to start trading, especially where from 3 p.m. over here South African time, when it actually starts to overlap, right? So this is basically the best time to trade, as you can see on this picture over here. If you want to know the exact time which these sessions happen in your country, you can just simply Google on you can simply search on Google, and then you'll be able to have those times. So a conclusion on this one, remember, London session, this is the London session, New York session, these are the best times to trade. But in London session, be careful of manipulations. The best time to start looking for opportunities will be around 10 a.m. in the morning. And then, as you know, if you've been following us here a day night Forex, we like killing Nasdaq around 3:30 over here, which is when the most companies in the Nasdaq stock will be opening up and then releasing their data, and basically this is when the market will move like crazy, right? So this is our favorite time to be trading Nasdaq. But as for you, you can also find your own time when you'll be able to trade which works best for you, right? So it's all about back testing your strategies and seeing what works best for you, right? So as you can see, this is actually a 3:30 candle over here. As you can see, there's manipulation to the downside before the market actually went. So it's not always a good idea to actually trade exactly at 3:30, but you can as we explained in some of our course videos, if you haven't watched those videos, they're actually here on YouTube as well, totally for free. So we made our whole course free for you to watch, right? So there's a video where we spoke about the best time to trade Nasdaq, especially during the times when this news is released. And basically it's always best for you to wait a little bit after this news has been released so that you can actually get an opportunity to enter in the market, right? So if you had just waited for this 15-minute candle to close, you would have had your perfect entry over here. As you can see, we had a double bottom confirmation here, plus a morning star with a bullish engulfing candle over here, right? So more than one confirmation for you to actually enter this trade, and you could have killed it right there, right? So this is why we say you mustn't react when it comes to your your trading strategy, right? So you have to actually stick to your trading plan and look for the trading opportunities, not to react based on the news, right? So if this candle open going to the downside and you place your trade thinking that the market is going to the downside because of your emotions and reaction to what is happening in the current market, you could have been killed, right? You could have lost all your money over here, because Nasdaq, remember, Nasdaq, US 30, these indices, they don't play, right? When they start moving, they will move with you, and basically if you are in the right direction, you are there to make money. Otherwise, you'll be feeding the markets, right? So be very careful when it comes to that. So London, New York session, the best sessions to be trading. That's when you should be looking for opportunities. Now, to move on with the rest of this video, we are now going to be talking about our Forex trading institutional levels, right? So these are the levels, the key levels in the markets where we are looking for trading opportunities, right? So this is where the big boys have placed their trades. Remember what we said about the big banks, you know, the big companies that are trading in these markets. They've placed their trades on these levels, and they are looking to basically, they're looking to take profit after the market has moved away from this level. So these institutional levels become key levels in the market, because we know when the markets, or when the big boys enter their trades from there, they are basically going to move the market price away from that point so that they can get into profits, right? So it's always best to trade with the big boys, not against them, otherwise they'll take your money. Now, there's a trick that we want to show you when it comes to this, to finding these key levels in the markets, right? So they are always rounded numbers, and in most cases they're actually plotted on the graphs in quarters, right? So every 25 points move on Nasdaq, you would actually find some of these key levels over here. Basically, what we mean by this is that the last two digits that you're seeing here on Nasdaq, we'll be looking at these two digits before the comma. There will be whole numbers, right? There will be in the 20s, in the 30s, in the 40s, and basically most of the common ones is the 10, the 30, the 50, the 60, and the 80, right? So these are the numbers where you find these key levels in most on most instruments, trading instruments. When you're looking at something like these forex currency pairs, basically you're looking at the last two digits over here, right? That is where you'll be looking for your trading opportunities. These are the key levels where you'll be plotting them. But here on Nasdaq, we're going to be showing you the quartiles theory, because basically with the Nasdaq, it will move in the 25s, right? So if you can just quickly plot some lines. So if I can just plot a line right here, and then I'm just going to plot another one right here. So I'm just going to show you exactly, I'm going to put 4 of these over here so that you can understand where these levels will be on the charts, right? So starting off with this one, we're just going to set the coordinates, the last coordinates over here. So here I'm going to set it to 00. So this will be our first whole number. So that one will go over there, and then we're going to select the second one. So we're just going to subtract 25 from 00, so that will be 275. We just want to show you the importance of these levels over here, right? So so that you can actually see how powerful these levels are. From there we'll have 250 as well. So that will be minus 25 from that level, and then here we're gonna have again 275. So we're just gonna subtract to 275, and then basically we have our levels over here, right? So basically the higher the time frame is, you actually use 10 times more the 25, right? So instead of just 25, you're going to be using 250 so that you can actually see the higher time frame. But right now we're just going to be using the 1 minute time frame or the 5 minute time frame, so that you can understand or see how important these levels are, right? So when you calculate in the 25s when it comes to Nasdaq, right? So as you can see over here, I'm just going to lock on my drawings so that we can in the zone that we just marked over here, and you're going to see that every time the price comes to these levels, it's actually respecting these levels, because this is the institutional levels, right? So as you can see, we didn't even plot any support or resistance level, but as you can see right here, this level has been respected just because we plotted this level at a 25 whole number, and it was broken here, it was retested, you had a nice beautiful signal here, and you could have sold from that point over there, right? So as you can see, this is the power of these institutional levels, levels. This is how you plot the institutional levels on Nasdaq. And as we said, for other instruments or for other forex pairs, is basically the last 2 digits after the point, basically the very first last 2 digits over here. You make sure those are either a 10, it's ending at a 10, it's a 30, it's a 60, it's an 80. Those will be your whole numbers. For Nasdaq, the best that we have found are the quartiles, which are basically the 25s, the 0, 25, 50, 75, and then again 0, right? So those are the levels where you'll be looking for potential buys. As you can see right now, the market just came to this point over here and it just gave us a morning star. So we could be looking for an opportunity to actually sell, to actually buy over here, and then our stop loss just below that level, right? Because we're not expecting the market to break it. And then as for our take profit, you could aim for the next level where the market tried to break or resist, or it was supported, right? So in this case, it will be this level over here, and as you can see, this will be our trade over here, a quick 1:2 risk to reward ratio over there. And basically this is how you draw your institutional levels, and this is basically what we mean by institutional levels, right? So this is how the institutional levels work. This is how we plot our institutional levels on Nasdaq, and then on forex pairs, as we said, you look at the last 2 digits, right? So these are the best levels where you can set your pending orders, and you have to pay attention to how the candlesticks are reacting to these levels, right? So as you can see right here, we had some dojis that are forming over here because it's a key level, right? So the big boys are trying to keep the price above that line or below that line. So basically you have to pay attention to how these candles are reacting to these levels, because it will actually give you clues and basically confirmation that you're actually looking at a very important level in the market, right? So that is what makes it an institutional level, because this is where the big boys are trying to keep their orders at. Another key thing is to always make sure that when you take your trades, you are always going with the trend, because the trend is your friend and you want to ride with the big boys, not against the big boys, right? So anyways, to move on with the rest of this video, we are now going to be talking about order blocks, right? So what are order blocks in forex trading? So order blocks basically create these institutional levels that we just spoke about right now. So basically, if you come to the charts over here and maybe go to, I'm just going to clear my charts quickly so that we can have a clean chart. Let's go to 15-minute chart so that we can just have some order blocks. So we can just take a look at some order blocks over here. So if you have watched our previous video, we explained the order block types that we have in this market, right? So the first one is basically the last candle before the push that goes to break out of the trend, right? So if we were in an uptrend, let's say we're making higher highs and higher lows, higher highs and higher lows, higher highs. Basically the candle that we'll be looking at will be the last bearish candle in this case, right? So this last bearish candle that will be here before the push that goes up to break this previous high over here, making a new high. That will be our bullish order block, right? So this is where we'll be looking for our trades, right? So this will be our bullish order block, and we'll be looking for our trades over there, right? So now with this bullish order block, we are looking for the market to come back and test the tip of it, or at least 50%, which is the equilibrium of that candlestick. We're looking for that 50% over there before the market can push up to the upside as well, right? So in most cases, it will only come to the tip of this depending on the momentum in the market, right? Otherwise, sometimes it won't even come. As you can see over here, it can just come to retest this level over here, which has been broken, and then now the market is going to test that and then move to the upside, right? But with this order blocks, in most cases, this is how the market operates. This is how the big boys trades, right? So if you can just find some examples over here, let's just see if you can find some examples over here, right? So as you can see right here, we have our low. I'm just going to zoom in a little bit. This is actually to the downside, right? So to the downside is basically the opposite of what we just plotted right now for the upside. If we go into the downside, we're looking, this is a bearish trend that we have over here. We're basically looking at the last bullish candle. So the last bullish candle before the move that broke the lower low, making a new lower low, right? So this is the level that we're looking at, that we'll be looking at to get our entry before the market can continue to the downside, right? So with this example that we're about to show you right now, that I just plotted over here, this is is exactly what is happening, right? So as you can see, this is a lower low, right? The market is in a downtrend, as we can see right now. This is a lower low that we have there, and then we have a lower high that came all the way here, and then we had the break of this low, creating a new lower low that happened over here, right? And now if you can see that the last bullish candle, as we said, if you're looking for a bearish order block, where you're looking at the last bullish candle over here, and this will be our last bullish candle over here, right? So if as you can see over here, we drew it from the tip to the highest point of it. We're also going to talk about refining order blocks. So in this case, we are on the 15-minute chart. We can actually go down to the 5-minute chart and even the 1 minute, but we recommend that you stop at 5 minutes or actually the 15-minute, unless you are busy scalping the market every minute, right? You are on the chart and you have the time to actually keep watching the price. Otherwise, the best order blocks that you can refine to will be the 5-minute and the 15-minute. And basically, when it comes to refining, it just means that you are increasing your risk to reward because you're now taking a trade much earlier than what you would find it if you're on a higher time frame. So in this case, this is our order block over here, and as you can see, the market actually came back just to the tip. As you can see, what we said, it can come to the midpoint of that candle, or it can only come to the tip over here and basically go with us over there. And as you can see, in this case, this is the market simply just came and tapped on it before it actually moved away from that point, breaking the previous low again, making a new lower low, and basically this is how the market will keep on going, right? So in most cases, you will find that there are some order blocks that are there, but they have not been respected. And later on, if you actually just let's say, for example, this one, if we extend it further, because right now this order block here, the market only came back to test just a little bit of it, right? It didn't go to the 50% of it, meaning that there's still a chance that this market could come back and try to retest at least 50%, and which basically means they mitigate the order block, right? So if the market has not gone past the 50% of this order block, then it can still be valid for the next for future trades. So if you can just extend this over here, you can find out that it actually came back into this zone again to retest later on over here. As you can see, it actually came back and then gave us another beautiful trade over here, all the way down here again. So this is what we refer to order block mitigation, right? So once it goes past the 50%, if I can use my gain chart over here to actually illustrate where the 50% point is at, so I'm just gonna draw it to that point over there, and that should be exactly on it. I think that is exactly on it right there. And as you can see, this is our 50% point of that candlestick, of this bullish candlestick that we have over here. So this is the 50% mark, and when it came back into that zone, gave us a bearish engulfing, or even a morning star, if you can see this pattern that is here, and then basically that gave us a trading signal for us to actually go down, right? So now remember, we spoke about refining a trade, refining an order block, right? So in this case, if we took a trade in this level where it is at right now, if we took the trade right there, saying that okay, we're anticipating that the market is only going to come back to test that level over there, we would then still set our stop loss somewhere above this level over here, and then our take profit, we usually target the previous lows, right? So in this case, this is the low where the market was coming from, so we would target over there for a nice 2.5, 1:2.5 risk to reward ratio over there. And as you can see that if we were to refine this order block right here, so I'm just going to mark it again with a block. So as you can see, we already marked it with the block that is over there, and then we're going to go down to our 15-minute chart, right? We want to see what happened at that level on our 15-minute chart, right? So I'm just going to zoom out a little bit so that we can pick it up quicker. So this is our setup that we have over here. We have our order block over there. So now we want to refine it so that we can have a smaller entry and basically increase our profits from this trade, right? From the exact same trade, but our profit will be increased, right? So as you can see with this one, there's not much difference, but basically our trade will be at this level right now, which is the lowest point of it. And if we come back and then just readjust our entry point to this level over there, you notice that we actually increased by 0.5 on our risk reward, taking it from 2.5 to now 1:3, right? So this is how you increase your returns on your order blocks, by refining them to a lower time frame. I mean, we said if you wanted, you could go all the way to 1 minute and then refine it even further over there, but in this video I think that we'll just keep it there at 5 minutes. As you saw, it actually helps out to increase your returns on that order block by just refining it so that you get a much earlier entry on the lower time frames, right? So that is what we refer to as refining order blocks. So when it comes to trading order blocks, you always need to start on the higher time frame, and then you can come down to the lower time frame to refine it so that you can refine your entries and get those and get in on those early entries so that you can increase your reward versus your risk, as we just showed you with that example of Nasdaq over there. The stop loss is just above the order block or just below the order block, depending whether you are trading a bearish order block or a bullish order block, right? So if you are looking for a bullish order block, which is the last bearish candle, basically your stop loss will be just below that level, right? So you just want to give it some room to breathe, so in case the market wants to come back and retest that level, you know at least you are safe, right? So this will be our order block right there. So in this case, we actually have an order block that you can see over here, which is this example that we're giving you. So if I spread it out to this side over here, in this case we actually missed it by just a few pips over here, but we can see that if we go to this level over here, we actually have something that is happening over there, which probably gave us another order block on the 5-minute chart or something like that, right? So if you can come down to the 5-minute chart and then just go and see what happened at that level over there. So if I can just quickly zoom out for you again, so that we can just see what really happened over there. But basically you could have caught a trade on the 5-minute chart. As you can see, now we are on the 5-minute chart over here. So remember, an order block is the last bearish candle before the push that goes to break the previous low over here, or the previous high in this case, since we're going to the uptrend. So this previous high over here, we broke it with this move over here. But where did it actually start? It actually started over here, because remember, as you can see right here, we had some consolidation over here. So this is where the actual move that broke this high over here actually started from, right? So this is where we'll be looking for our order blocks. So as you can see, when it comes to your order blocks, you always take the candle with the biggest body, right? You don't want to work with this if I can just zoom in over here, you can see that we have a lot of doji candles over here, which basically have short bodies, right? So we are looking for the candle with the most body, and that is the candle that we want to be using, right? So that is another thing that you need to remember. So the candle with the most body is the one that you use, as that one will give you more accurate order blocks, right? So if you can just pull this, as you can see, we could have been able to actually capture that trade based on the 5-minute order block in this case, because it didn't come back all the way to this level, because there was some consolidation that happened over here. This is the actual part where the market actually started to pull off from before it broke that recent high over there, right? So this is where you'll be looking for your trade. So always make sure that you're looking for your order block from the position where the move that broke the structure actually started from, right? So where it started from, that is where you're looking for your order block, and we could have been able to take our trades over there. Again, stop loss will be just below. So if we were taking it at the highest point over there, we would make sure that our stop loss is just below the lowest point in this case, and then we've been able to capture our trade over there. And remember, we said our take profit at the recent highs, recent lows, or the recent highs in this case, because we're going bullish. So the recent high in this case will be this one over here. As you can see, the market actually did come back all the way to that level before it started falling again, and that would have been just about 1:8. As you can see over there, about 8. If you're risking 1% of your trade, that means you would have made at least 8% on this trade over here, right? So you can see the power of refining your order blocks and also finding the best order blocks in the markets, right? So that is an example of order blocks. That is basically how these order blocks work. If you want more details on order blocks, you can watch the video that we published a while ago. You can just search order blocks on this channel, and you'll be able to find that video, so they can where we went even deeper in explaining order blocks. But to keep on with this video, now we're going to talk about the new order blocks that we want to introduce to you, which are basically the mitigated order blocks as well as the breaker order blocks, right? So in the previous video, we did talk about these order blocks, but we didn't go super deep into it. But right now we're just going to explain or clarify a little bit more on these types of order blocks, right? So breaker order block as well as the mitigation order block, right? So what exactly are those types of order blocks? So starting off with the mitigation order block, let me see if I can find one for you over here. So right now we have a clean example of the mitigation order block over here, right? So for let me quickly explain exactly what we refer to as to what we mean by mitigation order block, right? So when the market is in a trend like what we're seeing over here, so we have a higher high, a higher low, and then the market broke right there to make a new high, and then a lower, and then the market keeps on going in the uptrend, really, like that, right? So I'm just gonna quickly delete these things so that I can quickly illustrate where these order blocks are, right? A mitigation order block, this one will actually go with the trend that you are going, right? So in this case, we are in an uptrend, and then it will be the last bullish candle over here. The last bullish candle that created the point that came back for a pullback, that pushed the pullback over here before the market actually created a structure that came back to break that level over there so that the trend can continue, right? So this is the block that we'll be looking at, and if we highlight this block over here and then spread it out to the left, as you can see, and spread it out to the right, as you can see over here, it is perfectly where the market came back to retest before it went into the direction, right? So I'm pretty sure you've heard about the break and retest strategy, and this actually helps you to have a deep understanding of what is actually happening when we say the market has broken out and then came back for a retest, right? So it's coming back into these order blocks over here, and then from there it actually moves on, right? So in most cases it will not come back and retest this level where it is broken. It will actually come back and into these order blocks before it actually moves to the upside, right? So this is why we wanted to put this video out there to explain these mitigated order blocks as well as the breaker order blocks, which we're gonna go next into this after this one over there, right? So this is basically your mitigation order block. The market will pull away from there and then comes back to retest, and in that zone, that is where you're looking for your order for your trading opportunity. So you can set if you want to be away from the markets, you can set your pending orders right at the top of it. Remember, in most cases it will only just test the tip before it actually goes to the upside, or you can come back to test the equilibrium of that point, right? Which is the midpoint of that candlestick before it pushes to the upside with you, right? So those are the two levels that you can set your pending orders, and then as your stop loss, again, remember, you set it just below the lowest point in that range where you got your order block from. So in that case, it will be somewhere below this lowest candle over here. That is where we will be putting our stop loss, and then the take profit will be on the recent high over there, since we're going to the in the bullish market. So the recent high is where your first take profit will be. Remember, here day and night we actually prefer to trail our stop losses so that we can capture the whole move in most cases, and in this example over here, you would have been able to capture the whole move if you were using your trailing stop loss instead of a take profit. So that is an example of a mitigated order block. Remember, it's going with the trend. So oppositely, if we were actually in a downtrend, if I can find a downtrend example over here, so let's see if we have actually a candle over there. So right now I just scrolled a little bit further, so we just got a buy opportunity over there using this strategy, and now we are going here, and I'm already seeing another opportunity that we could have been able to capture over there, right? So remember, now we are in a downtrend, so we are looking to the downside, right? So the market is in a downtrend over here, as you can see. So our bearish mitigation order block would be the last bearish candle over here, which led to a move that did a pullback before the structure that came in and broke this low over here to make a new lower low that was all the way down, to make a new lower low, which in this case was quite far because there was some events that happened over there, and as you can see, this was our new low. If I can just go back to the top right there and then just zoom in again. So right here, this will be our mitigated bearish order block, right? So the last bullish candle before the pull that went back into this retesting zone, before it gave us the structure that broke this low over here to create a new lower low, right? So if you're gonna just highlight it over here from the top to the bottom and then spread it out to the right over there, as you can see right here, make sure it's actually on point right there, right? So as you can see right there, and then the market broke the structure and then came back into this point, and it actually came to the T, right? As you can see, as you can see right here, this would have been our entry position over there, right? So this would have been our entry position over there. This example, as you can see, if we were to set up our entry just at this point over here, which would be at the lowest point of our bearish breakup block over here. So as you can see now, the trading, our stop loss would be just above this range over here. But in most cases, to keep it much safer, you would want to put it above this level over here, which you would find on the higher time frame, right? So if I'm going to set my stop loss over there, but in this case, as you can see, all you had to do was to put your stop loss just in this zone over here, right? So I'm just going to mark this zone so that you can see it clearly. Right there. So this is where we found our order block, right? So this is where we found our order block, and we put our stop loss just over there, right? So I'm just gonna put it right at this point over there. Now, as for our take profit point, remember what we said, the previous lower low, because we are looking for the market to actually continue the trend, meaning it is going to break past this low, making a new lower low, and that gives you an opportunity to keep holding, right? So remember what we spoke about, the trailing of your take profit. You can either use a trailing stop loss, or you can also set your take profit at this level over here, meaning that when the market actually gets to that point, then it's going to take you out, right? So if you're going to keep your take profit at that level, that would have given us 1:6 for our risk to reward ratio, which would have been a good trade over there as well, right? So this is basically the explanation that we have for you when it comes to our mitigation order blocks, as well as the mitigation bearish order block, as well as the mitigation bullish order block, right? So this is an example that we've given you. So we had the example of a mitigation of bearish order block, and then we had the example over here of a mitigation order block for a bullish movement over there, right? So as you can see, these opportunities, they keep on creating in these markets, because this is how the market actually moves, right? So it moves with making these order blocks, because this is where the big boys are entering their trades, and basically that gives you the opportunity to actually trade with the big boys as well, right? So now let's talk about the breaker block. One of the best ways that I've noticed, or that I've picked up, or on how to actually spot this or breaker blocks much easier, is when you have the RSI, right? So if you add your RSI indicator at the normal settings, which is the 14 on close. So if I can just quickly edit my RSI over here. So these are my settings for my RSI. I have 70, 50 and 30, but those levels you don't really need them. And then the length is set to 14 close, so it doesn't matter whether you're on TradingView, you're on MetaTrader 4 or 5, still the same settings, right? So one of the best ways, as you can see, is actually to use divergence, right? So by divergence, it simply means that your RSI will be showing a different thing to your indicators, or to your market price, to the chart, what the chart is saying, right? So it's basically saying the opposite. So as you can see right here, we actually have equals over here, but here we are having a downtrend, right? So which can signal that there's something that is about to happen over here, because we don't have agreement, right? So as you can see, once again here, we're going downtrend, but here we are going uptrend, right? So this one is actually going uptrend over here, but this is going downtrend, right? So that is what we refer to as divergence, and basically we go with the direction which the RSI is showing us, which is bullish in this case. So the market is still going down, but we are anticipating that there will be a bullish move in the next coming few minutes, right? So that is exactly what we use to help us find these breaker blocks, right? So a breaker block, which is what I highlighted over here, is a last bullish candle before a move that came down to break the previous low that is here, meaning that basically the continuation is going on for the trend, but basically it's sort of a fake out, right? It's sort of a fake continuation over here, because then the market actually comes back and break past this point over here, the recent lower high that has been made over here, because we're in a downtrend. So we have our lower high, and then our lower lows over here, right? So it creates a new lower low, but then after that, instead of going to create a new lower high before it continues in the downtrend, it actually breaks this previous lower high, making a new high over here. Now this is actually showing us that we are now anticipating an uptrend over there, right? So once it makes that lower high over there, we're now anticipating that the market will come back and retest this zone over there, which is our breakup block. So the breakup block will be the last bullish candle if you were in an uptrend, and then it will be the last bearish candle if you were in a downtrend, right? So in this case, that will be our order block over there, and then we pull it out to the right, we extend it to the right, and then as we can see, the market came back to retest it over there. And once again, already know our entry points are either right there at the top of the order block or in the middle of the order block, and then our stop loss will be just below the zone where we got our order block from, right? So we got it from this zone over here, so that is where we are going to set our stop loss at, and then I'll take profit at the previous high over there. So that is where we are going to take our profit at, which is right over there. So we're just gonna go and see if it actually went to take our take profit over there. As you can see, it did eventually go there, but we got stopped out over here after it hit this order block that is over here, right? So you always need to so the best idea that we can give you, the best advice that we can give you, is to always draw out all your order blocks wherever you see them, so that you can actually anticipate that something will happen when the market reaches to that level. So as you can see, in this case, there was an order block over there, and the market came back to pull back into that zone, and then it continued to the downside, right? So in this case, this would have been your take profit point, because you have seen that there's another order block here, and we also have another one over here. But remember what we said, we always want to make use of order blocks that have body, the most body possible, right? So we wouldn't want to make use of the doji as our order block. So basically, that is the explanation that we have for you, or that is what we wanted to show you when it comes to the breakup block as well as the mitigation order block. And this is the order blocks types that we wanted to explain for you in detail, so that you can actually make use of them and increases your chances of making money in this market. So as you can see, it's something that works. It's something that you can back test on your charts and then see how many times it will work for you, and if it is something that you can add on to your strategy or actually build a strategy out of it, right? So back testing is always key, guys, because it will actually help you visualize it even more, so that you get used to seeing it on the charts, and it becomes easier for you to pick it up much easier than when you're just starting out, right? So back testing is very, very key. So as you can see, I'm just gonna clear my charts once again as we move on to the last but not least part of this video, which is the TDI strategy, right? So remember, we promised to help you understand this strategy even further, right? So this strategy over here, the TDI, is made up of different indicators. We have moving averages, we have the Bollinger Bands, we have the RSI inside here as well. So this is why we say this will help you pick up the W formations much easier, the M formations much easier. As you can see, already here we have an M formation over here, which is much easier to spot than here on the charts. Here on the charts, it is there. As you can see, this is one of our type of the 3 M's that we have. So remember, the three types M's that we have. Let me just quickly plot it much neatly here. Remember, with the 3 types of M's, we have our first M, which goes like this. So we have a high over there, and then we have an equal high, right? So this is the one type, and then and then the other type that we have one that has a higher high. So if we go this one that we have on the charts, so it looks like this, and then the second leg is a bit higher than the first one, and then it pushes down, right? So this is the M that we have. And then our third M, for those who are not familiar with our course videos, this is something that we also explained in the course, so you can go watch those videos if you want further explanation on these types of M's and W formations. But basically, these are the 3 types of M's that we have when it comes to the charts, when it comes to forex trading. So this will be your third M type, and this is the second type, and this is exactly what we're seeing on the chart over there, right? So it will be not much easier for you to notice if you know the TDI indicator. As you can see over here, it is well illustrated. It is much easier to see on the charts, as well as the W formation that I can see over here. If you can see a W formation over there, I think it will be perfectly visible if I zoom out a little bit, so that you can see that it's actually a W formation. Again, on the chart, it's not very much clearer. There's also the second type of W that we have. So remember, for the W's, it's just the inverse of this. So the second W that we have is that we have a first leg that is higher than the second leg. So the second leg is a bit lower, and that is what we have over here. So making our confirming that we actually have a W pattern, right? So this is what the TDI indicator will basically help you to spot in the market, right? So it is something that you can use on its own, but it's always best to understand the price action, what is going going on the charts, you need to understand your support and resistance levels. You need to understand the trend. So if you can trade, if you understand what trend the market is in right now, whether it's consolidating, is in an uptrend, is in a downtrend, then it will be easier for you to understand how to use this TDI, and it will be something that will be helpful for you. So like for instance, in this example, if you saw a W formation on the TDI and it's close to the upper range, to the upper Bollinger Band over there, confirming that we are oversold, because as you can see, this level over here that is marked over here, which is 68, is actually oversold. Is one of the levels that shows us the market is oversold. In that case, you would be anticipating that you are actually going in the downtrend, and you'd be able to pick up this pattern that we are seeing over here, which is a bearish engulfing. As you can see, the bearish engulfing candle over there, you've been able to enter your position from that point over there for a sell, right? So your stop loss above that point. If you can find a significant level on the left, you'll be able to use that as your as your stop loss level. Otherwise, you just keep it above that, above the highest point of your confirmation candle, right? And then remember what we said, you always aim for the recent lows or the recent highs, depending on what market you are trading. But basically, as you can see right here, we've been able to capture that whole move for about 1:4 over there on this trade. That is one way to use the TDI. Is a very simplified way to use the TDI. So you're looking for the M's and W formations in this case, and then you'll be able to capture your trade confirmations over there, right? Same goes for here. We actually have our morning star over there that have been confirmed by this bullish candle over here, which after the W formation that we saw here on the TDI. And then the other way, which is the most common way that people use this TDI, is to look for the so we have this red line over here, which we call the signal line, right? And then the green line is the